Welcome, future CPA. For this video, we're going to talk about PAS 32 financial instruments. Introduction. PAS 32 prescribes the accounting for presenting financial instruments as liabilities or equity and for offsetting financial assets and financial liabilities. PAS 32 complements PFRS 9 financial instruments, which prescribes the recognition and measurement of financial assets and financial liabilities, and PFRS 7 financial instruments disclosure, which prescribes the disclosures for financial instruments. PAS 32 applies to all types of financial instruments except the following, for which other standards apply: investments in subsidiaries, associates, and joint ventures, employers' rights and obligations under employee benefit plans and shared wage payments, and insurance contracts. PAS 32 applies to instruments designated to be measured at fair value through profit or loss and contracts for the future purchase or delivery of a commodity or other non-financial items that can be settled net. Financial instruments. Financial instrument is any contract that gives rise to a financial asset of one entity or a financial liability or equity instrument of another entity. Financial asset is any asset that is cash, an equity instrument of another entity, a contractual right to receive cash or another financial asset from another entity, a contractual right to exchange financial instruments with another entity under conditions that are potentially favorable, or a contract that will or may be settled in the entity's own equity instruments and is not classified as the entity's own equity instrument. Financial liability, on the other hand, is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instruments and is not classified as the entity's own equity instrument. Equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. One example of financial instrument is bank deposit. It is a contract that gives rise to a financial asset on the part of the depositor and a financial liability on the part of the bank. Cash is the most basic financial instrument, for it is the medium of exchange and the basis of measurement of all financial statement elements. The term financial instrument encompasses both financial asset and financial liability, but not the entity's own equity instrument. Examples of financial assets are cash and cash equivalents, receivables, investments in equity or debt instruments, and sinking fund. On the other hand, physical assets, intangible assets, prepaid expenses and advances to suppliers, and the entity's own equity instruments are not financial assets. Examples of financial liabilities are payables, lease liabilities, held for trading liabilities and derivative liabilities, redeemable preference shares issued, and security deposits and other returnable deposits. On the other hand, unearned revenues and warranty obligations, taxes, SSS, PhilHealth, and Pag-ibig payables, and constructive obligations are not financial liabilities.
Presentation. Presentation is where classifies a financial instrument or its component parts as a financial asset, a financial liability, or an equity instrument, according to substance rather than its legal form. Definition of a financial asset, a financial liability, or an equity instrument. Financial liability has a contractual obligation to pay cash. In the other hand, equity instrument has no obligation to pay cash or another financial asset. Contract. Contract is not an equity instrument merely for it is to be settled in the entity's own equity instruments. A contract based in financial liability, the contract requires the delivery of variable number of entities' own equity instrument in exchange for a fixed amount of cash or another financial asset. Fixed number and entities own equity instruments in exchange for a variable amount of cash or another financial asset. Variable number for a fixed amount as many shares as are equal to the value of a fixed amount. Fixed number for a variable amount to deliver a fixed number of own equity instrument for an amount equal to the value. Equity instrument. The contract requires the delivery, receipt of a fixed number of the entity's own equity instrument in exchange for a fixed amount of cash or another financial asset. Buying fixed number of the issuer's shares for a fixed price. When we say financial asset or financial liability, variable number for a fixed amount and fixed number for a variable amount. While we said equity instruments is about fixed number for a fixed amount. Equity instruments are essential features: the absence of a contractual obligation to pay cash or another financial asset. Its legal form is also irrelevant. What is redeemable preference shares? Redeemable preference shares is preferred stocks which the holder has the right to redeem at a set date and classify as financial liability. The issuer is mandatorily obligated to pay. What is callable preference shares? Callable preference shares are preferred stocks which the issuer has the right to call at a set date and classifies as equity instrument. Member shares in cooperative entities and similar instruments are equity if the entity has an unconditional right to refuse redemption of the member shares, or redemption is unconditionally prohibited by law or relevant regulations. One of the best examples of financial liability that contractual obligation to pay cash is the credit cards, because the credit cards is connected to the bank. When we use our credit cards to make a transaction or to pay something, automatically we have a debt at the bank. That's why some of the banks always sending us a letters of how much that we need to pay from them. So, in short po, umuutang po tayo sa bangko gamit po ang credit card. Mutable instruments. Mutable instrument is one that gives the holder the right to return the instrument to the issuer in exchange for cash or another financial asset. Mutable instruments is also includes the contractual obligations classified as a financial liability, except when the instruments also represent residual instrument in the net assets. Classified as an equity instrument if it has the features of an equity instrument. One of the best examples of mutable instrument is the warranty. When we're buying like appliances or a TV, they're giving you like a 1-year warranty to return if there is something like that to fix on the TV or damages. Compound financial instrument. Compound financial instrument contains both a liability and an equity component. Convertible bonds is one of the examples of compound financial instruments. Convertible bonds is a debt instrument for a bonds payable, and an equity instrument for the equity conversion features. Fair value of the whole instrument less fair value of the debt component without equity feature equals equity component. Basic accounting equation. Asset cash proceeds from issuance of compound instruments less liability fair value of debt component without the equity features equals equity component. The basic accounting equation is simply as ALE. Assets less liabilities equals equity. Entity A issues convertible bonds with face amount of 1 million pesos for 1,050,000 pesos. Each 1,000 pesos bonds is convertible into 8 shares with par value of 100 pesos per shares. On issuance date, the bond are selling at 98 without a conversion option. For the computation, the issue price represents the cash proceeds from the issuance of compound instrument or the asset, which is 1,050,000 pesos. Then, we are going to subtract the fair value of the debt instrument without equity features. To get that, we are going to refer to the face amount, which is 1 million multiplied by 98%. Selling at 98 means that fair value is 98% of the face amount. Therefore, the face value of the bonds without equity features equals to 980,000 pesos. Just subtract that and then you will get the equity component, which is equivalent to 70,000 pesos.
Treasury shares. These are the entity's own shares that were previously issued but were subsequently reacquired but not retired. It is presented either in statement of financial position or in the notes as a deduction from equity. No gain or loss arises in transaction such as purchase, sale, and issue or cancellation of entity's own equity instruments. It is recognized directly in equity. Interest, dividends, losses, and gains. In financial liability, it is recognized as income or expense in profit or loss, while on the equity instrument, it is recognized directly in equity. Examples: dividends on redeemable preference shares are recognized as expense in profit or loss, while dividends in callable preference shares are recognized directly in equity. Premium or discount on financial liability are included to its carrying amount and it's subsequently amortized to profit or loss, while premium or discount on equity instruments are recognized directly in equity. Gain or losses on redemptions or refinancing of financial liabilities are recognized in profit or loss, while redemptions or refinancing of equity instruments are recognized directly in equity. On the other hand, changes in fair value of a financial liability are not recognized unless it is measured through fair value through profit or loss, while changes in the fair value of an equity instrument are not recognized. Transaction cost. Transaction costs on issuing equity instruments are accounted for as a deduction from equity. On issuing financial liability, it is included in carrying amount and is subsequently amortized to profit or loss. Transaction costs on issuing compound financial instruments are allocated to debt and equity components, while the transaction cost that relates jointly to more than one transactions are allocated to those transactions using a rational basis of allocation. Lastly, Transaction cost of an abandoned equity transaction is recognized as an expense.
Offsetting a financial asset and a financial liability. A financial asset and a financial liability are offset and only the net amount is presented in the statement of financial position when the entity has both a legal right of set-off and an intention to settle the amounts on a net basis or simultaneously. Both conditions must be met before offsetting is permitted. PAS 32 requires presenting financial assets and financial liabilities on net basis. When doing so reflects an entity's expected future cash flow from settling two or more separate financial instruments. In effect, it has only a single financial asset or financial liability when the entity has both the legal right and intention to do so. Neither a legal right alone nor an intention alone warrants offsetting. A mere intention to settle net without the right to do so is not sufficient to justify offsetting, because rights and obligations associated with the individual financial asset and financial liability remain unaltered. A legal right to settle net without the intention to do so is also not sufficient to justify offsetting, because this does not reflect the entity's expected future cash flows from settling two or more separate financial instruments. Offsetting is inappropriate for financial or other assets that are pledged as collateral for non-recourse financial liabilities, and sinking fund and the related financial liability for which the fund was established. To sum it all up, financial instrument is any contract that give rise to a financial asset of one entity and the financial liability or equity instrument of another entity. Financial asset is cash, equity instrument of another entity, contractual right to receive cash or to exchange financial instrument under favorable condition. Financial liability is contractual obligation to pay cash or exchange financial instrument under unfavorable condition. An instrument is classified as a financial liability if the entity has a contractual obligation to pay cash or another financial asset or to exchange financial instrument under unfavorable condition. The instrument is classified as equity instrument if the entity does not have such contractual obligation. Offsetting of a financial asset and the financial liability is permitted if the entity has both the legal right of set-off and the intention to settle the amounts on a net basis. In this video, we learned about financial instruments, presentation, putable instrument, compound financial instruments, treasury shares, interest, dividends, losses and gains, transaction costs, and offsetting a financial asset and the financial liability. That is it for Philippine Accounting Standards 32 Financial Instruments. This presentation is based on Conceptual Framework and Accounting Standards by Zeus Vernon B. Milan, 2020 edition. Good luck, future CPA! Always believe in the power of your dreams.